Well, here we go. Welcome on back to another Meet Kevin live stream. We have a lot to talk about today. Wow, so much to talk about today. I don't even know where to start. It's look, hey, we're back, folks. This is really exciting. We've got we were just doing some really fun fundamental analysis in the course member live as we update our stock tab with our fundamental analysis, and we're like, oh damn, this stock cheaper than we thought and better than we thought. So we're really excited about it. We got a little carried away, I feel like. But anyway, now yeah, well, welcome on. Let's go see what's going on in markets today. We had a couple calls in the Meet Kevin Alpha report this morning. The first thing that we talked about is MP Materials rejecting 100, and we could see that very clearly. That's exactly what happened. And we might talk about our other calls doing well as well, but we'll give that a little bit more of a chance before I talk about what it is. So Myron's been yapping at the Fed, although I've been watching the notes on it. I haven't seen anything really interesting from Myron. We might go listen to that convo in just a sec, but no major notes here. I mean, I'm seeing don't care that gold is at a record. We've got forecast includes investment in the U.S. No plans to stay past Jan 31. Fed can do a good job of maintaining independence. I see disinflation coming a year from now. 2 more rate cuts sounds realistic. Fed independence is important. Expect unemployment to edge slightly down if policy moves down. Wow, yeah. All right. So that's actually, he's basically now, it's almost like Myron got in there and sort of shook up Powell a little bit, huh? Yeah, shook him a little bit. Very, very interesting. Okay, let's, I want to go see if I can find that. So that was just on CNBC. CNBC Myron speaks with Sarah Eisen. Oh yeah, here we go. All right. Can you let me know if the audio is okay if I do this? Or is the audio like crap static or whatever? I'll go back for a moment. Just technical difficulties. It sort of matches my mental very many challenges. But that's okay. We'll get it all worked out here. Okay, yeah, good to know. All right, no problem. We'll stick with this audio. Let's go see what Myron has. So Myron's talking to Sarah Eisen. Let's go listen in a little bit.
Which I'm participating in, and I think there's a lot of exciting work to do.
So we're in this period right now where the market is worried about the U.S.-China trade relationship. Looks like some hostilities are building again. How do you think that's impacting the economy?
Well, I think it's too early to say whether it's impacting the economy now. However, I do think it is potentially an important change to the outlook. And so, yes, the labor market continued to weaken in the first half of this year. I think that part of that was due to uncertainty over policy. We might have had the biggest tax hike in history, and so maybe there were firms holding off on investing until the tax bill was done. And we also had the biggest rearrangement to global trading policy in half a century. And so while those deals were being negotiated and people were waiting to see where tariff rates would shake out, it wouldn't be surprising to me if they held off on making some decisions. So I do think that uncertainty is a potentially helps explain some of the weakness we saw in the first half of the year. And then really until last week, I'd been operating under the assumption that a lot of that uncertainty had dissipated. The tax bill had become law, and trade deals had been made for most of our large trading partners. And then, last week, China decided that the deals that had been made earlier in the year in Geneva, London, and Madrid no longer bound them. And so I had been operating under the assumption that the uncertainty had dissipated and that therefore I felt more sanguine about some aspects of the growth outlook. And now potentially this is back because the Chinese are reneging on deals that were earlier made.
Right. So basically here now saying, hey, like things were looking good and now he's got this China spat. But remember, we always have Taco. So we should be okay.
And so I think it's incumbent upon us as policymakers to think about the introduction of a new tail risk. And the tail, the left tail has become a little fatter, as we might say. And we have to recognize that, there potentially is some difference now versus where we thought things were a week ago, and therefore adjust policymaking.
Downside risks to growth.
There's now more downside risks than there was a week ago, and I think it's incumbent upon us as policymakers to recognize that to get reflected in policy.
Isn't it a little early to conclude that?
Oh yeah, it is early to conclude that things are actually changing, right? But it's about where the balance of risk has moved, right? And risks exist now that didn't exist a week ago, that didn't exist a month ago.
I mean, you wanted much lower rates a week and a month ago. So do you want even lower rates now?
No, I wouldn't say that I want even lower rates now than I did a week or a month ago. However, with the change to the balance of risks, I think it becomes even more urgent that we get to a more neutral place in policy quickly, as opposed to sort of waiting for downside, as opposed to waiting for downside data to materialize.
I completely agree with this. And this is why I'm so grateful that Powell has essentially U-turned by going dovish. He already told us what to expect for the beige book today. He already told us that yesterday. And this is something, we hit as well in the Alpha report this morning. But this Powell move is insane. But the beige book comes out at 11. So it's pretty exciting.
Realize. To the extent that I think that policy is quite restrictive right now, that sets us up to be vulnerable to shocks.
Yes.
And if you hit the
Correct.
economy with a shock.
Great line. It's not that we are going to have shocks. It's that we are shock prone. It's the same thing with where the yield curve sits, right? We are shock prone. And that's what makes me, that's like the only thing that keeps me nervous, right? Is that shock prone nature. So what makes us shock prone? What makes us shock prone? Well, according to Myron says high rates, restrictive policy. Okay. In my opinion, IMO, shock prone, also 10-2 yield curve over 50, and private credit to include the BNPL bubble. We'll see.
When policy is very restrictive, the economy will react differently than it would as if policy was not as restricted. And so I think it's even more important now than I did.
Somebody in the chat says they got margin called. I'm really sorry to hear that. Yeah, it's always a crap feeling. You don't want to be in a situation. This is like eventually you just look and you go, no debt, no debt.
A week ago that we moved quickly to a more neutral stance.
But I mean, you were in the meeting for 2 days and you heard about the deliberation of your colleagues. Most of them don't seem to feel the same way you do. Is that right? Is that accurate to characterize?
I think that's right, and I think that it's fair to characterize my view as in some ways out of consensus. I have no problem disagreeing with people when I come to a conclusion based on analysis of data, based on analysis of economic models, and then I give my view. And I have no problem giving that view if it differs from the views of other people, whether my colleagues or not.
Fine.
And so I don't think it's unfair to sort of describe my view as out of that consensus in some ways, but I think in other ways it's very inside consensus. If you look at sort of the what people call the dots, right, the sum of economic projections, the only real material divergence between me and I think the rest of the committee is on how quickly we get to neutral, right? And so I wanted to get to neutral relatively quickly. I think a lot of other people have us getting to neutral also, but just maybe a little bit more slowly. And part of that difference, right, on the fact that I want to get there more quickly than others is because I'm less concerned about upside inflation in the near future, which then gives us the flexibility and the freedom to get there, I think more quickly.
What is neutral? And how do you know what that level should be?
Yeah, so that's a great question. I think we have to acknowledge that these models, so you can't observe neutral, right? The neutral policy rate is the rate at which monetary policy is neither restrictive nor accommodatory. It's you're not slamming the gas, you're not slamming the brakes, you're sort of just coasting along. And if you're below neutral, you're stimulating the economy. If you're above neutral, you're restricting the economy, you're holding it back. And I think it's important for us to understand that the models that estimate neutral tend to give us wide confidence bands. So there is some difficulty in knowing exactly where neutral is at any moment in time.
I mean, right now the idea is neutral is lower, so let's get lower. That's the idea, right? Hop to it.
However, I think it's a little bit easier to think about arguing from changes to neutral. And we know that there are some economic factors that push neutral higher, and we know that there are some economic factors that push neutral lower. And so recognizing that there's uncertainty about exactly where neutral is at any moment in time, to me, doesn't mean that we can't reason about where it's moved recently. And in my mind, the economy has experienced some very substantial shocks in the last few years, the types of shocks that normally would have taken decades to unwind. And, usually people will think that neutral moves only very slowly, that the neutral rate moves only very slowly, at a very glacial pace, because the things that drive neutral also move very slowly. And so think of, for example, population growth, right? Countries with high population growth rates tend to have high interest rates, and countries with low population growth rates tend to have low interest rates, right? That's because population growth helps determine the neutral rate. Population growth is normally something that changes extremely slowly, right? You get changing fertility rates due to cultural changes.
This is a really interesting interview. He's basically saying, we should cut way faster because neutral rate should be way lower due to rapid slowing of population, right? That usually population, like the Delta, he says this, usually population growth changes slowly, but the rate of population growth is now changing rapidly. Growth rate. That is interesting.
Or due to changes in medical technology that make people get married later. Or
somebody's writing Tesla. Let's go. Is Tesla running hard? Dude, Tesla was our second call in the Alpha report today. Let's see here. Yeah, 225. Let's go, dude. Let's go. NP down, Tesla up were the calls in the Alpha report this morning. Let's go. Yeah, I get excited about this. I love this. Like I just wake up every day and just like, all right, what's the play today, boys? And girls, one girl maybe
have fewer children or not get married at all. And so as a result, population growth will decline very, very slowly over the course of decades. But due to the sharp changes in immigration policy, we experienced the largest population growth shocks in our lifetimes in both directions, upside and downside, in rapid succession. We experienced population growth shocks in 3 years that normally would have taken 30 to 40 years.
Yeah.
And so to me, while I think it's important to be humble about knowing exactly where neutral is at any moment in time, I think it's easier to say that we know some of the drivers of neutral and
Sure.
can sort of observe what happened to those drivers.
You said that you are still very restrictive on rates, which is also kind of a point for debate because the economy is doing very well. So where do you see it being very restrictive?
Well, the economy was weaker in the first half of the year versus where it had been last year.
That was trade, wasn't it? Imports and exports stocking up before the tariffs.
Well, it was potentially related to trade. It was related to trade, to some front running of tariffs. It was related to some uncertainty around trade and taxes I mentioned before. But I do think other elements of core underlying domestic demand were weaker in the first half of the year than they had been in last year. Thus far from the third quarter, we have very little data to give us indications for the third quarter. But I also think that the labor market has clearly weakened somewhat over the course of the year, and the unemployment rate has ticked up, has been moving up gradually in the recent past. So I don't. And then you sort of look at something like the housing market, right? And housing is one of the biggest, if not the biggest, transmission channel of monetary policy into the real economy, and that has been I think rather moribund for a while now.
On high rates, mortgage rates.
Largely on high rates, yeah.
But if the Fed lowers rates, it's not guaranteed that mortgage rates will come down. We didn't see that last year.
So that's a great point. And so, last year, I thought that cutting was the wrong move, right? And it's related to this neutral rate conversation we were just having. So I thought last year the neutral rate was much higher due to a variety of factors, including things like population growth being higher, including things like deficits being wider, that raised the neutral rate. Which means that if neutral was here, so if keep policy here and neutral up here, then I think that policy is not very restrictive. And so I thought that cutting last year wasn't necessarily the right move. If neutral has come down and you keep policy here, then the distance between them has grown. And so therefore policy became more restrictive, even though you kept the nominal rate relatively similar. And so that, in my mind, is reasons for cutting. And so that's why I thought last year it was a mistake to cut, and this year it's the right move to cut.
And the market told you that, and you think this year market will go along.
Exactly. So in the, I think, 18 trading sessions since we cut rates
Wow.
in September, long yields are, I think, like 4 or 5 basis points down. In the same 18 sessions after the Fed cut rates last September, they were up by approximately 30 basis points. And then they went from starting from 30 to go all the way to about 110 basis points up.
So it's working.
So I think last year the bond market told you that cutting was a mistake. And I think that bears out that I was right. And this year thus far, the bond market is not telling you no. It may yet, right?
Sure.
But thus far, it's not telling us that we're wrong.
Well, part of it is the uncertainty around the China trade stuff. And so now the market is fully pricing in 2 more cuts for the rest of this year. Aside from what you want to see, does that sound realistic?
Aside from what I want to see, yes,
Just more.
that sounds realistic, and that's consistent with where the median projection from the committee was in the last summary of economic projection.
And I know it's early, but what are your expectations for how many cuts we'll get next year?
All of them.
It's early. I think there's a lot less disagreement from myself versus the rest of the committee on next year than there was in this year. It's purely a speed thing. And, we'll have to see what the committee looks like at that point in time. We'll have to see how the data evolve.
What about the inflation numbers? Because you could say the Fed shouldn't be cutting right now because inflation's been firming up. And I know that the Treasury Secretary said it's not tariff.
Yeah, but remember what Powell said yesterday. Powell yesterday said, hey, the inflation we're seeing is from tariffs, and we can look through that. The rest, the non-tariff inflation is nothing, basically. That's bullish.
Goods, it's in services, but it's still moving closer to 3 than it is to 2, isn't it?
Well, so here's where I think you have to be, where monetary policy has to be forecast dependent and not data dependent. I think that the data can be quite backward looking. And so therefore it's incumbent, because monetary policy works with a lag. It doesn't hit, if you hike or cut interest rates today, doesn't hit the economy tomorrow. It takes some time to get there. And people debate over how long these lags are. Everybody agrees they're long and variable. Most people think they're probably 12 to 18 months. But if that's the case, then you need to make policy today for where the economy is going to be 12 to 18 months or a year to 2 years from now, depending on how long you think the lags are. And if you make policy based on where prices were a year ago, you're just being very backward looking. And so you'll just continually be making policy based on, in my view, the wrong information. You'll only be making policy based on where you think prices are going to be a year from now. And so when I look at a year, I see substantial disinflation coming from housing, coming from shelter inflation, which is the largest component of inflation. It's about 45% of core CPI and about half of that of core PCE. And I see a lot of disinflation coming from there for 2 primary reasons that I've emphasized.
Let's hear it.
Well, that's one of them. The other one is the catch-up effect.
Wait, what was it?
The way that I see a lot of disinflation coming from there for 2 primary reasons that I've emphasized.
Immigration.
Well, that's one of them. The other one is the catch-up effect. And so the way that shelter inflation is calculated is kind of wonky. So basically, if
Owner's equivalent rent
is higher, the price you see on Zillow, the price that you would actually lease an apartment for or a house for, that rent moves higher, but you don't reset your lease for 6 months, 8 months, a year, or 2 years, however long your lease is. You don't experience the inflation until you reset your lease. And so and the way that the inflation is calculated is based on when you experience the inflation, not on what the current market rent that you'd see on Zillow is. And so if the market rent changes, there's a lag between when that market rent hits the lease reset because you moved or you renewed your lease or whatever it is. And so that means that there's a substantial lag in measured inflation data versus market rents that you would see on the computer or if you signed a new lease immediately. Now, what matters is that lag means that measured inflation eventually catches up to market rents. Now, there had been a very substantial wedge in between the 2 of them, meaning there was a lot of catch-up to do. And while there was a lot of catch-up to do, the fact that market rents were relatively stable didn't mean that measured inflation would come down. because they were still catching up to the old inflation in rents. Right now, that catch up is done. When you look at the data, you look at new rents versus average rents, the catch up is done. Means that the time at which measured shelter inflation catches down to where market rents is much closer now than it was a year or 2 or 3 years ago. Much closer now. The other thing that I think drives shelter inflation is the immigration story.
Yeah.
Okay, basically, the price you see on Zillow is starting to match up with how they collect the data. So because there's less of a difference between the two, inflation is lower. Because remember, inflation measures the difference. And if the difference is 0, then shelter inflation is 0. I feel like you could have said that a little easier.
You know, when you change population growth in an economy, most people consume and produce, right? They work in the labor market and they also buy stuff from other people and companies. And so supply and demand doesn't really change that much for most product categories, for most markets when you adjust population up or down, because supply and demand will move by similar amounts. Housing is an exception because the housing supply is suppressed.
Yeah.
Right? If you airdropped 10 million people into the country, you wouldn't instantly have 10 million new houses. You'd have 10 million new workers and consumers, but not 10 million new houses. If you took the 10 million people out of the country and airdropped them somewhere else, you wouldn't magically have 10 million.
How's that audio? Is that audio better?
It's relatively fixed. And so there's a really strong feed through into inflation from there.
But also, doesn't it put on the flip side upward pressure on wages when you have fewer immigrant workers?
I don't think so, because you have less demand also, right? And so
Is that what we're seeing in the weaker jobs numbers, do you think?
Well, we certainly are not seeing material increases in wage inflation that would make you think that the labor market was going back into the type of imbalance that we saw after the pandemic, right? That we're definitely not seeing. So those predictions, I think, have thus far been rejected by the data. But I think that there's plenty of evidence that changes to population growth affect consumption, affect supply and demand by similar amounts. And so, yes, you have another worker, but that worker is also buying things in the economy. And so if they're buying things in the economy, the supply and demand are moving together and you're not getting one outstripping the other.
So we were supposed to get an inflation report today. Didn't. Government shutdown. What do you think it would have shown?
Oh, well, that's above my pay grade.
How are you looking at alternative data sources? Like, how are you piecing together what's happening? You're going to have to make a decision at the end of October whether the government's open or not.
So I would love to have the data that we need to make the decision. We are fortunate that we only make monetary policy decisions outside of a crisis every 6 months. And so I'm still hopeful that we'll have more data by the time we get to the point.
6 weeks.
Yeah, sorry, every
6 weeks.
Sorry.
Yeah.
Thank you.
Yeah. That would be crazy.
Every 6 weeks. Yes.
Yes.
So I'm hopeful that we have the data in hand by the time we get to the October FOMC meeting. However, there's a chance that we don't. And if we don't, then I would rely on what I said a moment ago, which is that policy should not be overly data dependent. It should be forecast dependent.
That's not how the Fed operates, though. I mean, how many times do we hear Fed Chair Powell say data dependent?
I mean, I think that you want to be data dependent if you don't have a
Good
forecast.
response from Sarah. I mean, she's right. It's like so common. We literally have the Halo guy.
Data dependent.
Or you don't believe in your forecast, right? Or you don't have.
But if you look at the
forecast,
forecasts of the Fed in the dots, they project their economic and inflationary outlooks. They're mostly not right.
I think that is something that every forecaster should hold them, should hold themselves to account for when they're right or wrong, as I try and do, and change my mind when I get new information, as we did at the beginning of this conversation with rare earths.
Yeah.
And so I do think it is important to sort of have accountability for being right. But you want to be data dependent if you don't really have a forecast or you don't have a lot of confidence in your forecast. But if you have a lot of forecast and a lot of confidence in your forecast, then you don't really want to be as data dependent because that's so backward looking. And so for me, I have a forecast and the data matter insofar as they would lead me to change my forecast. But if they're not leading me to change my forecast, then I would still act in accordance with my forecast. And of course, there's a chance that some of the data come in and make me say, hey, I was wrong. It looks like housing inflation is actually moving higher. that rents are moving, that rents are moving higher, and that therefore, there's rent disinflation that I'm relying on for shelter disinflation, because shelter is such a big component of the measured inflation indices, that's not happening. And then I would say, hey, my forecast might not be right. I need to change this, or I need to sort of rethink my policy outlook. Right now, I think that for something like that, there are some alternative data sources, right? Like, there are plenty of ways to observe market rents that would make me think. And if you saw a surge in market rents, I would say, hey, it's time to rethink my inflation thesis. Like, there's a serious question.
We're not seeing that, though.
I'm not seeing anything that would make me seriously rethink the core elements of my forecast. I think I would be reading news articles about the housing market. I think I'd be reading news articles about the labor market. If there was widespread labor shortages or widespread layoffs or widespread, rent spikes or rent collapses or whatever, that would sort of make me think that my core forecast was really off. And so, it's really important that we get the data. We need the data to make our forecasts. However, for the short run, if you are forecast dependent, then what matters to you, is there anything that would make you change your forecast?
When are we, okay, here's a forecast question. When are we going to get to 2% inflation?
So, to 2% headline measured PCE.
Headline PCE. That's the target, right?
Yeah, I think probably, let's say, a year and a half from now or so, if I remember correctly, where my dots were.
A year and a half from now.
Yeah, approximately.
And where does unemployment go in that time?
Well, I think unemployment probably edges slightly down, not really far down, but probably slightly down. But that's also consistent upon actually accomplishing the policy outlook that I'm just giving you where my dots were, right? That also is reliant upon policy actually.
Contingent upon the Fed moving
down.
Okay, that's fair.
I worry that if policy stays this restrictive for that much longer, then the Fed itself will induce a slowdown in the economy.
Correct.
Because policy is so restrictive.
Are people right to raise the question about Fed independence right now?
I think that Fed independence is of critical importance.
Why?
Because you want to have policy decisions.
All right, this is part of the point.
Well, I mean, so first of all, presidents have long appointed former chair.
This part I don't know about. I want the macro.
He's not that interested.
Well, I'm here to talk about my economic views. It's not a subject I really know much about.
So the whole theme of the day is investing in America, and this is the grand finale, right? And we're talking about how the private sector has been, more active than we've seen, almost patriotic right now about putting money into America. Do you think that's in the economic forecast? Is it in yours?
So, there is some substantial increase in investment into the United States in my economic forecast. And if you look at the speech that I made, a few weeks ago at the Economic Club of New York, I talked about how there would be increased investment due to changes in tax and regulatory policy. I talked about how there was credit guarantees being given by some countries as part of the trade deals that had been negotiated with them. And I also talked about how FDI had been something else that had been an element of the trade deals. FDI I didn't really view as having material consequences for monetary policy because it tends to move the supply and demand of loanable funds by roughly the same amount, whereas the other two will just move the supply or the demand. And so I viewed them as more consequential for monetary policy. Okay, really quickly. Do you care that gold is at a record high? No, I care. I've been appointed into a role for which the Congress has told me focus on stable prices and maximum employment. And they didn't tell me focus on the value of gold. If that is the view of the Congress, I would encourage them to tell me that that's the view of the Congress. My risk premium embedded into other asset markets. I don't think
stocks are at a record high.
Yeah, I don't look at the stock market and say, there's something here that I'm missing about geopolitics that I don't understand that's being included in the gold market. And also, we started this by talking about shifting geopolitical plates, right? And potentially shifting geopolitical dynamics and how that might affect the economic outlook. So I don't think that this is something that I'm ignoring, that I need to sort of look to the gold market for some sort of clue about what's going on. I think, frankly, given the activities that I was involved in my last job, I probably know a little bit more about it than some other folks. Again,
if somebody were to sort of convincingly tell me that there's some signal about the economy that I'm missing from this, I'm very happy to hear the argument, but I haven't seen one.
Are you having more fun at the Fed or the Council of Economic Advisors?
Let me tell you, this is really sad. So when I saw the China rare earth announcement, of course, I started imagining what must be going on with my former colleagues and meetings that I had. You
were having like FOMO, trade war FOMO.
Oh, it's serious FOMO. And I was imagining all the meetings that must be happening and the plans that must, and what people were discussing or thinking about doing. And I spent the day, discussing whether a small regional bank should be allowed to make some modest change to its loan offerings. Thinking about this other stuff that was happening. So yeah, I had severe FOMO for
so more fun in the other job.
Well, it waxes and wanes.
Now you guys get to say that the outlook has deteriorated.
Well, there's a risk to the outlook.
Right.
There's a new risk to the outlook the outlook has not yet materially deteriorated.
Okay.
However, there's a new risk to the outlook that did not exist a week ago. Mm-hmm. And that risk is, that risk is here now in a way that wasn't true a week ago.
Right. I'm sure they would take your calls if you called your old team.
Well, you just spent some time talking.
We don't want to blur the independent. Yeah. Okay. Got it.
It's best that I let them do their thing and that I do my thing.
I agree. Stephen Myron, thank you very much.
Thank you.
I actually liked that interview. I thought that was really good. There was a lot of insight in that. We'll do a quick little summary on that in just a moment. But I like that interview a lot. I thought that was quite insightful. And so we'll break that down. But let me go see. We're going to go look at the sticks in just a sec. But I'm going to also go see what some of the suits are saying. Coco's rud. Gold sharp ascent can't be sustained for long. Gold's furious rally the past few weeks shows no signs of abating. And its incredible surge suggests a correction is around the corner. The slope of bullion's frantic run-up has been approaching vertical. Yes, it has been. Isn't that a wonderful thing? For all the good gold bugs. So the trouble with these kinds of returns is that they're seldom replicated, and there's ample proof from history. Gold surge rhyming with prior peaks sends a warning. Oh. Gold's latest surge paralleled what happened more than a decade ago when it ascended at a similar rate before crashing. That's a warning for investors. Bullion has been a gift that's kept on giving for the past 2 years. The last leg of its rally is approaching the vertical, and such a pronounced slope, which is measured against the time taken for that ramp to occur in the past. Okay. Gold is entering near vertical trajectory. Right. So, they're comparing this to the early 80s to the post global financial crisis rally and now. Interesting. Okay. In both instances, gold took 2 years before it reclaimed nominal peaks. Investors who had bullion in 1980 high would have had to hold it for nearly 3 decades to recover their capital. Holy smokes. Similarly, punters who speculated on gold at the peak of 2011 would have had to cool their heels for almost a decade before breaking even. Wow. That's interesting. Much of gold's recent rally has been predicated on a policy of uncertainty, questioning fundamentals on the backs of fiat. Huh. It makes you wonder, chart-wise, like what does that really tell you anything? I mean, you had in the 80s, you had a recession, but you were just coming out of a recession, 2010. So I don't know that that tells you anything. Cause see, look, let's go pull that picture. There we go. So, like, what do the 1980s say? Well, the 1980s, that was, the start of the Volcker era, right? So you get the start of the Volcker era. I'll hide myself for a sec. on the left, a little blue there, that's the run up into Volcker under inflation. And then you actually, after 82, you get a strong market. You actually really get, all of this crash right here walked into a double recession, right? So let's just see if we can make some notes here. All right, this double recession. And then, so we had a recession here, and then sort of another recession here, and then we had a recession here, and then we had a recession here. So this rally really came after the recession. You could almost argue similar to this. I don't think the gold sort of pop, should it pop, has anything really to do with a moment of the underlying economy. I mean, yeah, you've got uncertainties, but it's like, you had a pop over here in 2011 and it took 10 years to break even. But that wasn't a bad omen for the economy, right? 10 years to break even over here. And then here it took 30 years to break even. So this is more of just a note about gold than it is anything else, like a broader signal. It would seem that if we do end up, it's almost like gold comes down when the uncertainty fades, right? That's sort of what you got after 2011. Like, you could make that argument. I feel like that's actually a decent argument. So let's write that down. Gold down. But does it fall into recession? Gold falls as uncertainty fades. As uncertainty fades. I think we could argue that for both of those prior cases. Works in both prior run-ups. Where it really keeps going would be if, there's nothing to really justify keep going, because I guess maybe you could argue 2012, like if you still have to go through a recessionary cycle, right? Might keep going if recessionary cycle still ahead, right? So if you're soft landing, then gold should fall as uncertainty fades. If you're camp recession, then maybe there's still room to go. All right. Intriguing. That's very interesting. Somebody says shutdown over gold is. I don't know what you mean. Shut. Gold only rallies into recessions, dumps in recession. Yeah, we've talked about that before. But you had a rally going into the 2008 financial crisis. Then you had a dump, but then you actually, under fear, uncertainty of a double dip, you rallied. You know what it is? It's really, it's like a uncertainty gauge, right? So you might be uncertain before a recession, you might be uncertain after a recession. It's just a gauge of uncertainty. That's all it really is. Gauge of uncertainty. That's what I would call it. All right, cool. So how are we doing here? So Bitcoin slipping a little bit, a little slippy lippy. 111. Okay, let's go. AMD's holding the line. We talked about this line this morning in our course live as well. NVIDIA, Alt 5, silver's up. Tesla still got 2% over here. Nice. You've got, one of our top 10 stocks to buy is up like 50% in like the last 2 months. And I'm like, oh, I want to buy more of it, but it's just gotten so expensive. Remember, you get that in the Meet Kevin report. So, okay.
Let's see here. Myron, gold. Okay. Let's see what else we have here. Let's go to journal, the Doomers. So Besson floats longer tariff truce. New Yorkers face tax hikes. IMF. Rainier cuts. It's fine. Fine. Trump threatens retaliation. Whatever. BlackRock. Okay. People really didn't like the cockroach comment from Diamond. Okay. Wall Street Journal. Lost crackdown. UN's about to tax you. China betting it can win a trade war is playing hardball. Yeah, they are. Changes to Medicaid plans. America's favorite Apple is a farmer's nightmare. Chinese criminals from texting. Giant new AI data centers coming to the epicenter of the fracking boom. CoreWeave and Poolside in West Texas. The frothiest AI bubble is energy stocks. Yeah, actually, I've stayed far away from energy stocks. I agree with that. Because it's just a pure commodity, right? You have to be really careful. Okay, let's go to the information. Okay, what do we have here? The race to run out NVIDIA chips. Anthropic gets ready to start going shopping. That's fine. Amazon playing fresh layoffs. This is, I thought, in the HR division. I think they're doing like 15% in HR. Amazon solution to tough AI cloud margins, non-NVIDIA chips. Oh. They found one way to improve AI cloud margins, custom server chips. Yeah, I mean, this totally makes sense. Over time, you're all just going to call TSM yourself, you know? That's quite reasonable. All right, what's going on here? Qs keep rising. Tesla needs a little bit more love. Although very nice over the 433. 1.7%. It's pretty good. MP Materials trying to bottom out over here. Okay. Let's go. Let's go look at CBCs. All right. So, bonds basically flat. It's actually good. That trend is continuing in the right direction. Oil, stable. Gold now 42. Holy smokes. That's impressive. Walmart to deploy IoT sensors, Internet of Things sensors. I want to see what sensors they're deploying. Oh yeah, this was in the Wall Street Journal like a week ago. They're a private company. We looked at them in the course member live stream because we were trying to get ahead of this. That's our goal, is try to see things and get ahead of it. That's why I think one of the fundamental analyses that we did this morning we're really excited about. We were like, oh, we might be pretty damn early to this. Anyway, all right. So let's see here. All right, cool. Let's go do a quick little breakdown of Myron and the gold thing. And we'll get to yapping. Okay. And the gold chart. We've got the gold chart. Okay, perfect. Well, the Trump shill Myron had a great interview with Sarah Eisen this morning. I loved it. We watched almost every single minute of it, and wow, I got to give you a breakdown of exactly what he just said, as well as provide a little bit of a risk for gold. There are some bearish murmurings around the direction of gold. A spoiler alert, it's on screen right here. We'll talk about gold in just a moment. But let's talk about Myron. So Myron says that the left tail is getting fatter. Now, this guy speaks in tongue. He speaks in a really complicated manner that's really honestly not meant to be understood by anyone. I think there's a word for that, like arcane or just like annoying. But anyway, as much as when he first came on the scene, I just called him a Trump shill, I have to say he's turned out to be pretty damn good, and I kind of like him, and I kind of hope he doesn't leave the Fed. I actually think he'd be a really good Jay Powell replacement, but he ain't in the running for that. You got to get more of a wet blanket in there so they can do what Trump wants. This guy's good. So he says the downside risks are now growing because of the trade war that we have with China, but we can fix it. We can fix it by lowering rates a lot. He's basically telling us that the main thing he's paying attention to is what's going on with rental inflation, because it makes up 25% of personal consumption expenditures, which is the Fed's preferred inflation gauge, and 33%, 34% of CPI. And he tells us that if you look at where market rents are, they've been relatively stable. And when the lagging owner's equivalent rent data catches up to this, we should have virtually zero shelter inflation. He also says we don't see any signs of rents skyrocketing anywhere, and mind you, I completely agree with him. No signs of rents skyrocketing anywhere, which is really exciting and a really good thing. So I'm jumping up and down about that and excited about that because it means lower inflation, which you might think, oh, but Kevin, you guys should be liking rents going up. No. I'm all for making sure this economy doesn't go into a recession. Lower rates via lower rental inflation is a great way to do it because it'll drive rents or it'll drive yields down on 10-year treasury or mortgage rates. It'll actually increase housing affordability, which is actually great for the housing market. Now, think about what else Myron just said. Myron said that usually in a low population growth environment, the neutral rate should be substantially lower. Basically, we should cut faster because the neutral rate should be even lower because population growth is potentially turning negative. Now, he says the reason we might be stuck in a more restrictive position is because we just came out of the craziest, weird, up and down in population. We had population spike like crazy post-COVID and open border policies, and now population growth is going negative under closed border policies and deportations. So you have this complete flip-flop that usually would happen over decades that happened in less than 5 years. And so his view is that high population growth is artificially leaving some members of the Fed keeping rates higher, and that we really need to get rates lower, even lower than people forecast. He says if we get rates lower fast, then we can actually see the unemployment rate go down, which is fantastic. That's exactly what we want. And that's really exciting because if we can get the unemployment rate to go down, then even if we do see a little bit of an increase in layoffs, it could be absorbed essentially. Consider for a moment what's going on at a lot of companies. Look at what Amazon just announced. Amazon just announced that, hey, we're going to lay off 15% of our human resources staff. Now, why do you think they're doing that? Come on, it's AI. So we know people are getting kicked out. We know people are getting a kick in the butt, and they're going to have to go out in the labor market. We know layoffs are quietly ramping up. And if they all hit at the same time, it's going to be a big pooper duper. This is why it's so important. The Fed go dovish. And I think Myron might be one of the reasons why we got Powell to flip. Now, we did get a heads up on what the Beige Book is going to say, which is really exciting. The Beige Book and what happened with Powell yesterday is why we made a couple calls this morning in the Alpha Report. One of the calls we made was Tesla up. The second call we made was MP Material down. Remember, you can get the Alpha Report of the Meet Kevin membership every single day by going to meetkevin.com. But MP Material, clear as day, rejection yet again at 100. So keep an eye on that one. Free point out. But the beige book comes out at 11 this morning. The beige book, Jay Powell already told us what the beige book is going to tell us. And it creates a little bit of maybe good, maybe bad, and some updates regarding gold, which we're going to talk about both of those. But first, I want to just shout out my sponsor that I'm really excited about, investing.com. If you haven't yet checked out investing.com, this is the rare time where they run the flash sale. So the flash sale, the timer's frozen on this, but the flash sale ends, I believe it's within 23 hours now. But they also sent me this beautiful water mug, which is really nice. They're a sponsor, okay? But anyway, you get 50% off, but if you use my coupon code MEETKEVIN, you get an extra 15% off. And one of the things I've really loved about them is not only getting my forward EPS, which you've seen me talk about that before, but I love their pointers, their filters on like, hey, here are undervalued stocks to look at. Now, I always like doing my own analysis, but I love the head start that I get with Investing Pro. And so check them out. They're a great sponsor of the channel. You can check out here. I've got a banner we'll go ahead and throw up on screen right here. Look at this. Use my coupon code MEETKEVIN, get the extra 15%. Their flash sale ends soon. And check them out. Like, even go through the investing website, see what you think. Realize that it's very different than Investing Pro, though. So if you go to investing.com, you might get confused because you're like, all right, this is just sort of like the news website. But what you really got to do is you got to jump on into the Investing Pro tab. And then we could throw in, get company ideas. We could choose a company. Let's choose Etsy, for example. I mean, some of these things we know we can get at various areas, such as, I can get overviews like this on Webull, right? But what makes it so unique is what I can't get on something like Webull is this. These forecast consensus. People spend 30 grand a year for stuff like this. This makes me so excited. In addition to, if I ever go pop on a plane and I'm sitting in the back, I ain't flying myself. I love this. Look at this. Auto-highlighted PDF that I could get. I could pull up 10 of these for different companies and do an analysis just on a quick slap together, one button press from me and a lot of effort from investing.com. It's kind of cool. So I'm excited that they're a sponsor of the channel. I encourage you to check them out. Go to, scan the QR code down below. Use that coupon code MEETKEVIN. Great sponsor of the channel. So now that said, let's talk about this gold warning because there's a big gold warning right now. And this is where you've got a lot of people saying, hey, Powell tells us that things are good, but gold is saying things are not good. That's something to remember. Is gold is skyrocketing at levels that we just generally don't see. Look at this. This right here was in the turn of the 70s to the early 80s. We got this vertical development in gold prices, and as soon as we went vertical, that was the top. The vertical aspect, the slope of the line going vertical. That was the top. And so you can see the slope of the line here is approaching vertical. And then, of course, we had a top. Now, this top right here in the 80s took 30 years to recover from. 30 years to recover from. So if you bought at the peak, it took 30 years for you to break even. Then we had this happen again in 2011. We went vertical after the financial crisis, which is weird because here you went vertical before the double dip Volcker recessions. Here you went vertical after the great financial crisis. Gold had a spike going into the recession and then fell during the recession, but it was actually in the uncertainty after the recession that gold went vertical. And then if you bought at the top, it took 10 more years to break even. Now you look at gold and it's got the same vertical pattern. Now, it's unclear, is this vertical pattern happening because we're about to go into a recession, just like the early 80s? Or is the vertical pattern happening because we're coming out of a recessionary era and, we're about to soft land, but there's still so much uncertainty? Who knows? But what we do know is that gold falls as uncertainty fades. So I would make the argument that if you think the economy is going to go into a recession, maybe gold still got some room to go. If you think the economy is going to soft land, you might be knocking on the door of tops that we might not see again for decades in gold. Now, that's not to be super bearish. It's just to basically say, you kind of got to pick your side. What side are you on? The uncertainty side or no uncertainty side? Now, keeping in mind this, remember what Powell told us yesterday about the beige book. Powell already told us about the beige book. Because Powell already told us about the beige book, when I turned on my live stream this morning, I'm like, hey, I'm actually bullish on what Powell told us is coming today. And therefore, I'm excited about, the broader market. I mean, look at the cues. From pre-market, we're well up from pre-market. Tesla's up, MP Materials down. I mean, these are the things we talked about in the Alpha report this morning. But one of the reasons is Powell already told us that the Beige Book is at least as strong as the data that we saw in September. And the economy today, again, is either at least as strong or stronger than what we saw then. Now, that doesn't mean we aren't going to have a normalization of the Beveridge curve, which is bad for layoffs and the unemployment rate. But remember what Myron says. Myron actually says, listen, if we start acting and we start cutting, we're going to remove the shock risks from the economy and we could actually soft land. So that means you've got Myron in there really drilling for lower rates. Like get rates down, get rates down, get rates down. I don't know. I want to be very clear about this, okay? I have no idea if we're going to soft land or go into a recession. I'm telling you, I'm like right here on this line. And it's like, which way is the wind gonna blow? Are we gonna go, recession? It's like an arm wrestle's happening, Or, soft landing. I don't know. But we are at a shock-prone position. Myron tells us we are shock-prone because of high rates. There are two other reasons we are shock-prone. Number one, the 10-2 yield curve being over 50, and then obviously the potential for a private credit bubble and a BNPL bubble. Not great. Those are things that could contribute to a real shock. We saw leverage get flushed out of the system on Friday, although that Binance situation was a little excessive. It was probably fraudulent, but then again, many of you already know my opinions on Binance. I've been shitting on Binance since before it was popular to dump on Binance. But anyway, the 10-2 yield curve is another issue. That makes a shock prone. And then obviously the private credit and buy now, pay later bubble, in my opinion, that's brewing, it's just a matter of time. I'm not even mentioning AI in this. But these are real shock-prone issues. So I think Myron is right on when he suggests we got to get rates lower. This is bullish, by the way, for rate plays. This is bullish for interest rates down over the next 2 years. I think you have to be cautious going, I'm going to, go crazy into some kind of like options, betting that in the short term rates are going to plummet. I think patience is more important here. And I've made that mistake in the past where I've been too impatient, but I think the trend is very, very clear. And I think that's why we're already starting to see a surge in refinance applications or purchase applications in real estate. And it's just a matter of time before, as rates actually come down. I mean, here you go. Here's the Goldman Sachs piece on this. Mortgage purchase applications rise 14% year over year. Refinance applications rise 18% year over year. Look at the blue line right here. Let me try to point this out because it's so tiny. It's a little hard to see. Okay. Stupid document. I hate it when they do that to me. This the PDF is locked. You need to duplicate it. Shut up. There. Okay, so right here you could see purchase applications. You could see that uptick. It's like barely starting to uptick, right? Imagine you get back to this era over here. I mean, 1 in 5 mortgages right now sits over 6%. That's insane. That's very expensive. So the refinancing boom is going to come eventually. We're just now starting that trend up. So that's just a matter of time. And Myron's a perfect shill to keep pushing for lower rates. But I think he's right. I think he's right about that. And then over here, you've got those purchase applications popping up, which if you look, historically, where we sit on purchase mortgage applications, look at the line. Let's make this a little thinner right here. Let's draw this line. Oh, come on, buddy. Let's get a little bit of a thinner line here. There we go. Yeah, look at where we sit right now. We're like at the bottom of purchase applications volumes over here. It's like, does it make sense at this point to say, hey, take your money out of gold and throw it into mortgage plays, interest rate sensitives? I mean, look at how historically low we sit on both purchase and, this one's a refinance over here. Whatever, this one's refinance, this one's purchase. But anyway, this is insanely low where we sit. And so I think Goldman has a very, very valid chart here to pay attention to. But take a little screenshot of that, steal that. It's fantastic. So shout out to Goldman there. But yeah, I mean, this is all a big deal. And so good on Myron. I mean, fantastic interview. And he really makes it clear that, Powell, you need to get off your ass and start stimulating. I gotta stop saying bad words. You gotta get off your poopy doopy. The thing is, I think Myron showing up at the Fed actually somewhat helped Powell turn dovish here. You know, Powell didn't say much in the Q&A yesterday, but in his prepared remarks, him going, listen, you know, we're going to turn off the vacuum cleaner because it's time to, you know, start supporting the economy again. Hopefully it's not too late, but it's bullish. And remember, gold down as uncertainty goes down. Anyway, so again, shout out to investing.com and their Investing Pro sale. So check them out, obviously, at the QR code. I'll go throw that QR code up on screen again so you have it nice and convenient. And then, of course, remember, you know, we can utilize the Investing Pro software together with what we do in the Meet Kevin membership, which is great. So if you haven't checked that out yet, go to meetkevin.com. Grab that Meet Kevin membership, baby. You get all 8 courses, the new lectures coming out, every trade alert. I'll let you know when I'm selling or trimming something. I'll let you know when I'm buying. I'll let you know what I'm buying, my top 10 stocks to buy for the next 10 years. There's one I wanted to add to this morning, and then I look and I'm like, dude, it's up 50% since we started buying it. I'm like, what the hell? Anyway, you get all the courses. You get the Alpha Report every single morning, the Wealth Plan, which was a financial advice library, which is awesome. All the course member live streams, Trumponomics, you name it. So check it out over at meetkevin.com. All right. Now we're going to have to talk about the Binance situation here soon, but let's first, I want to see what the doomers are up to. Probably dooming after all. They were the ones who were dooming about, what were they dooming about? Gold. They were the ones. So what a surprise. They're the doomers. It's all right. It's all right. Somebody in the chat says, more coupon codes, please. Yes. So the coupon is linked below.
Coupon linked below.
You know, that's sort of like when you go into Halo and it's like 3 minutes remain.
Fetch me.
I do that to the kids and it bothers them. You know, they'll ask me like, Dad, how much time is left on my timeout? And I go, 3 minutes remain. They just get pissed. They're like, shut up. I'm like, I'm a dad. It's my job to annoy you. So. Somebody here in the chat says, arrest CZ. Yeah. Somebody here says, nope, won't buy a liability, a house. That's all right. You could always put your money into HouseHack. See, by putting your money into HouseHack, you don't have to deal with that. You get the benefit of diversifying to real estate while getting the potential upside in our AI, play on real estate. But at bare minimum, you get that diversification into real estate. So you can always go to househack.com, read the solicitation, the private placement memorandum, or the offering circular, depending on which investment round you're looking at, and take a peek at what we're doing. There's a HouseHack update video on the channel. Just type in like HouseHack update AI or whatever, meet Kevin, and you'll see it. So pretty exciting. Will power ever return to the people, and can oppressive effects of Bitcoin ever be reversed? What do you mean the oppressive effects of Bitcoin? Somebody says make a coupon code banner. You know, I really need to make a coupon code banner. My last coupon code banner, no, I already removed it. I need to put in the new banner up. You're right. Thank you for that. Are you serious? CNBC reported yesterday that Cathie Wood interviewed Powell. Even they were fooled. Shut up. Wait. I gotta see that. Hold on. That's. He's like, I look closer. That is Cathie Wood. No way. Hold on. I gotta pull that up on the broad screen here. All right, give me a sec. We're gonna listen to this D-Wave shill, and then we'll look at that. That's hilarious. Thank you for sending that to me.
With respect to the power of the processor, we recently published in.
Dude, this guy is gonna like go down for like financial fraud, in my opinion.
Materials on our quantum computer in minutes,
Shut
that
up.
it would take nearly 1 million years to compute on the fastest supercomputers in the world. So this is literally computing properties that can't be computed classically. This is what everybody in the quantum industry has aspired to, namely the ability to do something important and useful on a quantum computer that can't be done classically. And this Advantage 2 quantum computer has achieved that goal.
I believe you solved a physics problem on the behavior of magnetism, particularly in certain solids. What's interesting is the turn of phrase arguably, Alan. Why is it only arguably the most powerful at the moment? How is your technology differing or still trying to measure itself out versus others out there?
Yeah. So when it comes to the ability to perform a computation on a useful problem that can't be solved classically, we have the only quantum computer in the world that is capable of doing that today. I use the word arguably in the context of largest when I talked about 4,400 qubits. And the reason why I did that is because D-Wave quantum computers today are what's called annealing quantum computers.
Yeah.
Everybody else in the industry is pursuing a different approach called gate model quantum computers. And while they have many fewer qubits, the nature of the qubits is a little different between annealing and gate model. So we believe that at 4,400 annealing qubits, we are significantly larger than anybody else, because all these other gate model systems have tens to a few hundred qubits. But there's an academic debate around the difference between the qubits.
What's interesting is you are making and generating real revenue. It's small, but it's there. But the market capitalization of yours and many other quantum computing companies has just gone so far up and to the right, Alan. Is the promise and hope being shown up in reality from orders? Because this is Europe taking a 10 million euro step forward. What about other deals?
Yeah. So we announced at the end of last year that we had sold a quantum computer to the Jülich Supercomputing Center in Germany. They purchased that system to connect it to their Jupiter exascale supercomputer to explore new AI workflows. And then earlier this year, we announced that we had signed a memorandum of understanding with Yonsei University and Incheon City in South Korea for the acquisition of a quantum computer there. And we have, frankly, a number of other countries and research centers that are interested in acquiring our quantum computers as well. And that's just with respect to purchasing of the quantum computers. Our quantum computers today are also used commercially in support of a broad array of business applications. For example, North Wales Police is using us to compute the best way to forward place police vehicles to be able to arrive at incidents in a timely fashion. These customers use us over the cloud. So we have both a cloud-based business and an on-premise business.
North Wales, UK or Australia?
UK.
Fascinating. Absolutely fascinating. Thank you very much indeed, Alan Baratz. It's learning about the European focus that you seem to be having with the business, in particular, US-based company, and the new announcement out of Lake Como. We wish you well over there, D-Wave CEO. Now, coming up, HSBC is upgrading NVIDIA from a hold to a buy. That's as AI demand shows no signs of slowing down. We'll talk about the new price target.
Yeah. Dude, literally in the Meet Kevin membership this morning, we talked about this line. This very freaking line. You can't make this stuff up. 433.99. Beautiful bounce. Bullish. Nice. But what the hell, Bitcoin? Bitcoin's coming up a little bit. MP's still down. Q's. Long expectations here. Come on, TLT, man. Just release the jobs report so I don't have to be in cloud. We get these two jobs reports and what's going on with the Fed. This is just gonna rocket over 100 fast. Hashtag no guarantees. Don't sue me, bro. I'm just a dude on the internet.
And Tricolor, are recent bankruptcies cause for industry concern? Blue Owl's co-president Craig Patrick is here to help answer that question after the break. Stay with us.
After the break. Break this. Oh, I'm not going to stay with you. How about that? Punishment. Punishment. Switch away.
Betrayal.
The hell. They're a commercial too. Looks like somebody had a house hack question. You know what that means.
Email ir@househack.com.
House hack. All right. So we're going to have to talk Binance in just a moment. Freaking Binance, dude. So we'll catch up on them, and let's see. With Face the Nation, why healthcare premiums are a sticking point in the government shutdown fight. We saw that. Okay. All right, let's see. Let's see what some of y'all are saying here. Well, everyone's on commercial. So how much coffee have you had yet? Let's see here. Somebody says, the lady has a gig in Vegas posing as Kathy Wood if she ever wants. Yeah, she can hand out selfies. That's funny. And even minimums to invest once already invested. Once you're already invested, just email us, ir@househack.com. We'll take care of you. Let's see here. Quantum encryption, quantum business. Let's see here. Somebody says they're going to dress up as a Lyft driver for Halloween. Oh, wow. Aaron Juan says, this guy keeps promising quantum computing for the next 15 years. Well, yeah, it's go back to, their revenues, man. Just look at their revenues. It's crazy. Let's see here. Somebody says Microvision is trending again. Summer's doing well. Yep, thank you. TLT is going above 26 mil on VWAP. It's going to be diabolical once it gains momentum. Nice. If HouseHack had a mascot, what would it be? A chart that goes up and to the right. Okay, no, I can't say that. The SEC is going to get mad at me. I'm just kidding. HouseHack logo, Warglaves. Yeah! We will go to war for you. That's why I think it's fun, the name Reinvest too, as a doing business as for HouseHack, because it's sort of like, hey, reinvest some of your profits from the stock market into diversifying into real estate, right? Plus the AI upside. That's just bonus. Okay. So let's dip in over here. And then in a couple minutes, we'll do Binance.
Bloomberg's equity reporter, Ryan Vlastelica. And Ryan, they are seeing significant market cap accretion to NVIDIA on what over at HSBC?
Well, it's not going to come as a surprise to many people, but they are touting the growth potential of artificial intelligence. Specifically, they see the total addressable market of these AI chips expanding beyond the hyperscalers, which are the major NVIDIA customers right now, Microsoft, Amazon, Alphabet, Meta, and so forth, and really sees that expanding beyond them into other parts of the economy. So as this continues to grow, they see NVIDIA's earnings continue to grow, and eventually leading it to the market cap you said before, I think was about nearly $8 trillion. So certainly a significant jump from where it is right now.
They're the most bullish when it comes to the overall analyst recommendations, Ryan. How much are you seeing portfolio managers echoing that sort of fervor and excitement? Because we've had a lot of talk of bubbles. Just yesterday, we're discussing them all.
Yeah, so I do hear some people talking about, having a certain amount of skepticism. Can this continue to go on the way it has been going on? But even when I ask them specifically, do you see maybe new competition threats from AMD or Broadcom, just given some of the deals that those companies have announced this past week? they still continue to like NVIDIA. They still see it as the market leader. It continues to have a dominant market share in the market for these GPUs. So no one is very bearish. I think there is one analyst on Wall Street right now who has a sell equivalent rating on NVIDIA, but other than that, people are pretty positive about it. I'd also note that as it continues to grow, the multiple has been coming in a little bit. So these are not the kind of .com era multiples that some of the bubble concerns might be indicating. These are certainly a little bit above their medium-term average, but certainly not at the levels that would be, a real nosebleed.
Bloomberg's Ryan Vlaselica. Thank you so much for the breakdown. Let's talk more about the AI compute demand right now, because it's time for Talking Tech. And Microsoft data center builder developer Nscale, well, they've just reached a fourth deal, this time to build a site in Texas with power capacity as much as 240 megawatts. The UK startup says the site will have over 100,000 new NVIDIA chips. The GB300 is scheduled to open in the third quarter of next year.
Wow.
Plus an investment consortium, including BlackRock's global infrastructure partner, Abu Dhabi's MGX, Microsoft, NVIDIA, and many more agreed to buy Align Data Centers for $40 billion. This is the first deal for that partnership that the investors established a year ago to invest heavily in AI data centers and energy. And CoreWeave is partnering with startup Poolside to develop a massive data center complex in West Texas. Now, the site will be powered using local natural gas and is expected to generate as much as the Hoover Dam. Look, let's talk more about all of this AI investment news. Thomas Martins with us, Senior Portfolio Manager at Globalt Investments. Got north of $3 billion in assets under management. Thomas, is this a bubble?
Well, thanks for having me on your program. And of course, that is the question that people are asking when things like this just go, parabolic, to use a word that captures the imagination. People wonder, how long can this go on? And they start comparing it to the past. We don't believe that it's a bubble. The underlying factor and force is the usefulness that can be gotten from these AI models, and we're only at the very, very beginning of that. Companies are having varying degrees of success at implementing these, and the compute power that's needed is prodigious. It's already been said, and all of these deals really articulate various aspects of what is going on with bringing this kind of compute to the folks and companies that need it.
But Thomas, what fundamental data are you looking at that shows productivity and revenue will be there?
Well, that's kind of the rub, is that data is not really there yet in a way that you can put your finger on it and count on it. And I think that's why you're getting some of this questioning. So a lot of what's going on is betting on the future that problems are going to be solved, and this is going to be productive. And you see that in the beginning parts of what's going on. Just anybody as a consumer who is using AI to just ask it questions about anything can see the improvement, but that's not what really is going to drive it. It's going to be very complex things driven by businesses and agents and automation that is still very much to come, and which will require more chips than we have and more connectivity that we have.
Yeah.
So the need for that compute is gigantic.
Amid supply chain headaches and worries and anxiety around China, whether or not it can keep buying some chips the US makes, more broadly, whether we'll get the rare earth metals that are needed for a lot of this supply chain, Thomas, how do you factor in the risks of geopolitical?
Yeah, whatever. Who cares about this geopolitical crap? All right, listen, we got to talk about Binance. So this is fascinating, what's been going on at Binance, but let's go talk about it as well as what's going on with Bitcoin and some volatility lately. So here we go. All right. A lot of you know that I have never been the biggest fan of CZ or of Binance. It all goes back to years ago, the interview between CZ and Sarah Eisen, where Sarah Eisen bluntly and in numerous different ways asked CZ, do you actually have the reserves to back the funds you say you have? And he dodges the question over and over and over again, suggesting, oh, well, we have a proof of reserves audit. But remember, that the scam with the proof of reserve audits, and then we're going to get into the drama that contributed to this scam in Bitcoin, which we have a lot to talk about with 19 billion in liquidations. Of course, Binance is now airdropping some breadcrumbs back to people, but we'll talk about that in just a moment. Understand quickly how proof of reserves work. If you have 10 stable coins, let's just use a very simple example to simplify this. Let's say you have 10 stable coins, tokens, whatever. Let's say you have 10 buckets, and each of them are worth $1 billion. Well, technically, to support all of that infrastructure, you would need $10 billion to say they're all backed 1-to-1. But what people do with proof of reserves financing is they say, yeah, we have $1 billion. And if you compare 1 billion to stablecoin 1, yep, we've got 1 bill. Compare it to stablecoin 2, yep, we've got 1 bill. Compare it to 3, yep, we've got 1. But they might actually only have 1 bill compared to the total of 10 that they say they do, while at the same time saying, yeah, we've got proof of reserves when we compare 1-to-1. So you gotta be careful with this. We don't know if that's exactly what's going on, but that sketchiness from that interview years ago has always made me skeptical that the people at Binance are shysters. And I've been a big fan of getting away from any of these exchanges. Like, people use them for trading, which is great, but you want to be off these platforms, not your keys, not your crypto. Unfortunately, people get suckered into leverage, and that's where we end up getting a potential for a disaster like what we had with Bitcoin here. So let's understand what happened not just with Bitcoin on Friday, why Bitcoin fell, but why that led to a cascade of problems at Binance. So here's what happened. There were a lot of tokens like Atom that fell to roughly 0, or IODEX or ENJ. These fell a lot. The problem that happened on Friday under the catalyst of Donald Trump's trade war was that Binance was just in the process of moving, about 8 days left, they were just in the process of moving to actually quoting prices on their platform using market pricing elsewhere, which is known as Oracle pricing. So the way this basically works is if you look at market pricing on a stock, let's understand this because this will help you understand exactly what happened a lot more easily. Let's look at AMD, for example. When you look at a stock like AMD, you see it's trading for $236 on Robinhood. Well, Robinhood isn't using their own order book to determine AMD's pricing. They're generally going to use information directly from the NASDAQ or New York Stock Exchange. And so understand that all the major brokers, whether it's Robinhood or Webull or Tasty Trades or Interactive Brokers or Charles Schwab or JP Morgan, they're all looking at one data feed. They're looking at the exchange's data feed for where that stock is listed, which means you see the whole order book, which is really important because if you see the whole order book, it means you're going to have the thickest book available. Now, why does that matter? Because if some big whale comes in with a $10 million order, let's say, and they hit the sell button, well, for AMD, if you're using the NASDAQ's pricing, you're probably not going to eat up the order book because there are plenty of people. You hit a $10 million sell, you've got plenty of people willing to buy in that order book. Now, what if Webull said, you know what? We're actually going to use our own order book. We're not going to use the NASDAQ's pricing. We're just going to use a book that is only our customers. And now somebody comes in with a $10 million order, but you don't have enough buyers to match up with that. What happens then is the price could actually artificially plummet way more than it should based on using data available from the entire market, because you're not using price discovery from the entire market, you're only using price discovery from Binance. So of course, if you have a lot of sellers on Binance and you're only matching up to buyers on Binance so Binance can go try to make some more money, then in a market panic, they end up screwing you, the user on Binance. Now, understand, Binance got exposed for this issue. People knew this was an issue and people said, we need to fix it. And so what did Binance do? Binance said, all right, we're gonna go ahead and update our software. We're gonna update this software to make sure that we're going to use
pricing that is widely available. We're going to end this design flaw and we're going to use Oracle data. And so that way we don't have stuff like this happen. Here's, for example, a particular read of USDE to USDC on Curve. And what you find is that broad market data for the stablecoin showed the stablecoin during this shock, this tariff shock on Friday, the stablecoin only dropped to 99.57 cents, which is actually really nominal for a stablecoin movement. And generally, algorithms come in really quickly and buy this up. The whole point of algorithmic trading is that algos say, oh, well, this is a stablecoin. It's supposed to be trading at exactly $1. If it goes down, we're going to buy it up and stabilize it back to $1. If it goes up, we sell it. And that's how they make money. It's sort of like being a market maker. That's how they make their money. The problem is, if you actually look at what happened on Binance, in Binance's case, this stablecoin collapsed when you compare USDE to Tether, for example, which again should be stabilized at 1. It actually collapsed to 65 cents. And because it collapsed to 65 cents, all of a sudden people's accounts looked like they had just lost a bunch of value. Which you think, okay, a 35% drop, should that matter? Not if you're cash. But if you're on leverage at Binance using 10 to 20x leverage at Binance, you're screwed. Because now all of a sudden 20x leverage or 30x leverage turns you into an instant liquidation. And this is why a lot of people on social media were complaining and they're saying, hey, wait, this is ridiculous. We just got liquidated before our stop losses could even trigger. That's not good. Now, Binance comes out and suggests, oh, well, this is because of heavy market activity and we're under load and users might be experiencing delays displaying issues, which that also led market makers to withdraw offering bids on Binance, which just exacerbates the issue. See, if you're a market maker in a panic, you can make a lot of money by providing liquidity. You know, people want to sell, you provide liquidity at wider spreads, and you go make it up on other platforms, but you pick up the spreads. In English, market makers love volatility. But the problem was, Binance's system was so damn overwhelmed that your funds weren't Seifu because the market makers dipped out because they're like, we can't even get your software to work right now. It's glitching out so badly. We're just not going to provide quotes. We're not going to quote on Binance. And so what happens? You get even more of a deterioration because it now looks like the market makers rugged. Now, the market makers, who knows? Maybe they were in on it. But the argument is that the market makers rugged because the Binance platform failed. Now, is it a chicken or egg problem? Who knows? But a lot of people in this flash crash, which is seen as the worst since 2017, look at this and say, this was insider manipulation. That people knew about this glitch. People knew that we were going through this transition. Here it is, a suspicious window. On October 6th, Binance announced plans to fix this exact problem. The exchange said it would switch from using its own order book prices to more reliable external data. The change was scheduled for October 14th, which was yesterday. But the flash crash happened on October 10th, right in the middle of the 8-day window. This leads a lot of people to say this was an attack. This was a coordinated attack to utilize this screwed up order book one last time and mint billions of dollars. And then, of course, give some of the money back as breadcrumbs. Now, of course, you kind of have to pick your side on this, but Binance is not just in the heat for this. Binance is also getting a lot of heat right now for this basically leaked offering of how Binance forces new ICOs or coin or token listings to provide a lot of sort of their base token or their order book, if you will, and some of their reserves to Binance. So either Binance can profit or to potentially stabilize the market. Now, this depends on which way you want to look at it, but take a look at this. All of this has to do with this guy who has a company called TriLimitless. Not sponsored. I haven't checked it out or anything about it. But this guy's following's been blowing up, CJH Tech. And his following's been blowing up because he got an offer from Binance for listing on Binance. And the offering on Binance
was very different from Coinbase. Coinbase said, hey, if you want to list on Coinbase, just build something meaningful. Binance says, hey, we want you to give us 1% so we can do an airdrop on day one when we list it. Then we want 3% of your token supply so we could airdrop that in 6 months to kind of keep momentum going. Then we want 1% to pay for our own marketing for your product. Then we want 100% of total value locked for a token pool on PancakeSwap. We also want a $250,000 security deposit, they say, to prevent rug pulls, which there's some argument for this. 3% to be reserved for the BNB hodler program, $200,000 worth of tokens to be set aside at the best possible pricing for Binance affiliate marketers, and $2 million of a BNB security deposit to get you a listing on Binance. So basically, we want like $3 million worth of assets, and we want you to put those where we direct them, into our marketing, into our Binance stablecoin, or it's not actually the stablecoin, the BNB is not a stablecoin, but into the Binance token. We want you to pay for our marketing, and we'll do all this stuff for you, but you're going to pay for it out of the proceeds from your offering, and you're going to put all this money in as a security deposit, so that way you can't rug, or at least you reduce the chances of rugging. Now, this offering was supposed to be under an NDA, but what happened is CJ got the offer from the Binance salesperson before he ever signed the NDA. This is what he says. And Binance is now lashing out. Like, CZ blocked this guy. CZ is, and Binance are claiming that this guy's a fraud, that he shouldn't be leaking this information. But all it's doing is actually providing more evidence. See, here's CZ. Wow, this guy really clout chasing, but what a loser. I didn't even know who he was until he posted a fake image saying I blocked him. I could make it real, but I will choose to mute instead. Ignore is the best rejection. Meanwhile, CZ is literally lashing out on X, and he probably blocked him and then unblocked him or whatever. This is just leading people to combine these two things and go, man, there's some shady stuff going on at Binance. So did Binance have anything to do with this order book manipulation and this $19 billion rug pull that left people seeing their life savings absolutely destroyed? I mean, you had people complaining about getting rugged for $9 million instantaneously. The market reaction was so violent, heavily because of Binance's failed order book system, that, here's a guy who was like, I thought about taking my own life. I lost $400,000. There's another guy who's like, I lost $9 million basically instantaneously. Worst day of my life financially. And these are people who've got like Binance and BNB in their username on Twitter. These are people who are like super excited about Binance. They love the leverage they could get there. They're super like gung-ho users of this platform who got rugged. And so a lot of folks are pissed. They're going, wait, Binance is now going to give, I think it's up to $300 million in, actually I wrote down my notes on this. Binance is giving some money back in the form of an airdrop, but a lot of people are like, dude, this doesn't even scratch the surface of the damage that was caused. So if you look at the distributions, Binance is going to distribute between $4 and $6,000 in USDC, totaling $300 million, to eligible losers who were liquidated by at least $50, and the liquidations represent at least a 30% loss ratio of the account. Now, what's really interesting about this is $300 million divided by the user base that got liquidated here works out to about $187 of stimulus per one trader, because 1.6 million people lost because of that Binance glitch. That works out to $187 per user, $4,000 to $6,000 range. Worst downturn since the FTX disaster. So a lot of folks are like, this is crazy. It was their fault $19 billion got liquidated, and they're giving a fraction back at the same time as people see this manipulation of potentially new listings as just a way for Binance to profit off of the backs of people. Now, other people say, hey, this is actually just Binance trying to stabilize new listings. And I think they have somewhat of a point there. I think new listings are quite likely to often get rug pulled. So requiring security deposits is probably a smart thing. Not surprising. Now, is it Binance's fault that they ended up leading this, cross-margin liquidation, which is basically where you leverage up your wrapped Ethereum or wrapped Solana positions or your stablecoin positions to get 20 to 30x leverage on Binance? Is it likely that that very leverage system and the failures of the technology platform led to a lot of people lose money? Of course. Which is ironic because now what a lot of people in the crypto community are doing is they're actually saying, hey, we need a regulated exchange. Which is kind of hilarious because the whole point that people got so excited about with crypto was that, oh, it's going to be deregulated. DeFi is great. But this is exactly what happens when you have unregulated broker dealers and exchanges. Now, most of the lawsuits from the SEC against platforms like Binance have been dropped because Trump has gone, all in pro crypto. But this is exactly why people are like, bro, nobody likes the suits, but you want some safeguards at the suits. And this is why investor protections exist, because when people get rugged like this, they're like, yo, where was the government? And it's like, well, you wanted DeFi, even though it's a centralized exchange, obviously. You wanted no regulation. You wanted less regulation. So it's kind of ironic now how many people are like, I'm taking my money out of Binance. I want a regulated platform. It's like, well, yeah. Anyway, so this is now where people are joking like your funds are not Seifu at Binance, because Binance always says this. Seifu has to do with, their desire to say that funds are backed one-to-one, especially in stablecoin assets. But again, I started this whole segment out with saying you got to be careful of that pitch because we've never actually seen, at least I haven't, maybe I'm wrong, maybe it's out there, don't sue me, bro, this is my opinion here, right? But the reserves in the Seifu fund, they're designed to protect users in emergencies, but this is not backed, at least that I've seen, by credible audits. So the Seifu fund, yeah, it exists, but we don't have the actual transparency to say, oh yeah, we're actually good here. It's not like there's SIPC protection that you have that's backed by, or like FDIC protection that's basically backed by Jerome Powell. You don't have those sort of backings. So the fund exists, lacks independent, verified third-party audits as far as I can tell. They show Binance, they show wallet addresses, but we don't know what kind of debts are against that, right? So we have to be careful of that as well. It's easy to flash around a wallet address, but how many liabilities are against that? So you gotta be really careful with these platforms, they're in a little bit of a poopy doopy. Is Binance going to go bankrupt here or whatever? No, they'll get through this. They'll be fine. But it's something to pay attention to. Now, I know a lot of people are talking about Hyperliquid. Look, what you have to remember is leverage. Leverage. In this sort of market, if there's anything that I could advocate, and I hate sounding like this because it's so Dave Ramsey-esque, and I've always been a big fan of mortgage debt and secured loans and that. I have never before in my life been of this mindset that this is a great time to do whatever you can, especially at all-time highs, to pay off debt. Do whatever you can to pay off debt, get out of debt, be safe. Because look, I get it. We love that stonks are going up. This morning on the Alpha report, we're like, hey, MP Materials, it's gonna go down. Rejecting off 100. It's done it multiple times before. Look at what's happening, okay? We were at pre-market, we were at $98.65. It's now at $89. That's a 9% decline from what we talked about in the Alpha report this morning. My point is, downturns can happen very, 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 very quickly, and you need to be prepared for that. And the best way to be prepared is not losing sleep at night because you're gonna get margin called, you're gonna get screwed by debt. Understand the debts you have in life. It's not just credit cards, it's not just buy now, pay later, it's not just margin debt, it's all of it together. Household debt and it's taxes that you owe, right? Remember, you got tax bills coming, credit cards, buy now, pay later, utility bills, mortgage bills, rent payments, car bills, car debt, student loan debt, whatever. All that shit is fine when we're at the top of the market. But when we go into a recession, which I pray we don't, but when we do, all that stuff stacks up
and it makes for a really crappy decade. Because, you know, I think if we hit a recession, it's going to be a decade of hell to try to actually get people jobs again. That's why I hope we don't. And so that's why I'm a big fan of preparing for that. Anyway, that's my take on what's going on with Binance. All right, with all that, I actually have a really important meeting to go to for House Hack in 2 minutes. So I have to go to the bathroom, and then I got to go to this meeting. So I love you all. I'll see you in the next one. Goodbye. Good luck. Stay safe out there. And get life insurance in as little as 5 minutes by going to meetkevin.com/life. That's a paid promoter of the channel.
I think that Kevin's a brilliant guy, and I think that we'd all be very lucky to have him.